What if I told you? Some millionaires legally pay a lower tax rate than nurses, engineers, and even teachers? Not because they cheat. Not because they hide money in the Cayman Islands. But because they earn differently. I spent weeks studying public disclosures, IRS summaries, UK HMRC reports, financial interviews, and case breakdowns of 50 self-made millionaires, entrepreneurs, investors, real estate owners. And I noticed a pattern. Not one of them relied mainly on salary. Not one. And that's where the entire tax story changes. Today I'm breaking down what they actually pay, why their tax rate looks low, the biggest myth about the rich pay nothing, and what this means for you if you live in the US or UK. Stay till the end, because the twist might change how you think about income forever. Let's compare two people in America. Person A. $120,000 salary. W-2 employee. Federal tax. State tax. Social Security. Medicare. By the time it's done? 30 to 35% effective rate isn't unusual. Now person B. Owns a business. Owns stocks. Owns rental properties. Net worth, $10 million. You'd assume person B pays 45 to 50%, right? Sometimes, their effective rate is lower. Why? Because salary is the most expensive way to earn money. And nobody tells you that. When someone like Warren Buffett says, "I pay a lower tax rate than my secretary," people get angry. But here's what he meant. His wealth grows mainly through long-term capital gains, dividends, appreciation of assets. In the US, long-term capital gains tax is typically lower than top ordinary income tax brackets. In the UK, capital gains rates are also generally lower than higher-rate income tax bands. That's not a loophole. That's tax code. The system encourages investment and ownership. So if your income comes from ownership, you're taxed differently. That's rule number one. Here's where most people get confused. Let's say someone owns $20 million in shares of Amazon. The stock rises 20%. They made $4 million. But they pay zero tax. Why? Because they didn't sell. That's called an unrealized gain. Tax only happens when there's a sale. Now here's the powerful move wealthy investors use. Instead of selling shares, they borrow against them. Banks lend money using stock as collateral. Loans are not income. So they live off borrowed money while their assets keep growing. Is that illegal? No. It's how the system is structured. And yes, this is common among high net worth individuals. Now let's talk about property. Imagine a real estate investor in London or Texas. They buy a $2 million rental property. That property generates income. But they deduct mortgage interest, repairs, property management, insurance, maintenance, depreciation. Depreciation is the interesting one. Even if the property increases in market value, on paper, it loses value yearly for tax purposes. That reduces taxable income. This is why some real estate investors show low taxable income while building massive net worth. Look at how real estate heavy figures like Donald Trump structured losses and carry forwards in past filings. Again, political opinions aside, the structure matters. Employees pay tax first, then spend. Business owners spend first, then pay tax on profit. If you own a business, office space? Expense. Software? Expense. Travel? Expense. Marketing? Expense. Staff salary? Expense. Even part of your home may qualify as home office deduction in the US. That doesn't mean luxury write-offs are unlimited. But the flexibility is real. When I looked at those 50 cases, here's what I saw. They focus on reducing taxable income legally, not hiding money. There's a huge difference. Here's something most people never hear about. In the US, when someone dies, their heirs often receive assets with a step-up in basis. That means the assets cost resets to market value at death. So capital gains tax on past appreciation may disappear. In the UK, inheritance tax works differently, but similar wealth transfer planning strategies exist using trusts and allowances. This is one reason why generational wealth compounds. It's not magic. It's structured planning. And yes, it's debated politically. But it's legal. Now let's kill the myth. Do millionaires pay nothing? No. That's lazy thinking. Many still pay millions in absolute dollars. If someone earns $50 million and pays 20%, that's $10 million in taxes. The difference is percentage, timing, and structure. Not zero. And here's the uncomfortable truth. The system doesn't reward income. It rewards ownership. Before you get angry, ask yourself, are you building assets? Or are you only building income? Because as long as 100% of your earnings come from salary, you're locked into the highest taxed lane. That doesn't mean quit your job tomorrow. It means start investing. Learn about capital gains. Understand tax-advantaged accounts. Consider business or side income. Build ownership. Taxes are not just something to complain about. They're something to understand. And the more you understand them, the more control you gain. The rich don't win because they hide money. They win because they understand structure. If you want to complain about the system, that's easy. If you want to learn how it works, that's power. Subscribe if you want real breakdowns like this. Because smart money decisions aren't emotional. They're strategic.